1 crore, 2 crores, 5 crores. Apartments in India are getting more expensive. But the demand, that doesn't seem to be slowing down, Vineet. People are still buying these high-priced apartments. Just look at this number. Real estate developers sold a record 3.6 lakh crore worth of housing in the first half of 2025. And when these developers sell, they make a lot of money. And when that happens, investors get excited and they buy these stocks. In the past 5 years, a stock market index made up of just real estate companies has delivered over 200% returns. And some companies, well, even 500% returns. So, Vineet and I, we decided to investigate what's going on in India's real estate industry. And we thought we'd answer 3 questions that you might possibly have about real estate in this video. Number 1, where are we in the residential real estate cycle? Is the demand still strong or have we peaked? Number 2, what are the parameters to look at when we are buying a real estate stock? And number 3, and I think this is the most interesting one, Vineet, which is, should you buy a house or take that 1 crore and invest it into the shares of a real estate builder? And to answer all of this and to get a better understanding of the real estate industry, we spoke to 4 experts for this video. Nirupa Shankar of Brigade Group, Manan Shah of MICL, Rahul Agarwal, who's a fund manager at Bandhan Mutual Fund, and Vishal Bhargava, who has been a real estate observer and a writer.
Welcome to T-1, a video series by Zerodha Varsity. In each episode, we'll explore the biggest trends shaping India's industries to help you make smarter investment decisions. We focus on the big picture so you can better understand the forces that truly move the stock markets.
So, let's start with understanding the residential real estate cycle. Because very honestly, Vineet, even I'm quite curious about this entire demand versus supply equation. And there's a term that I've heard quite often, unsold inventory. Everywhere I look, I see that the builders have a lot of flats that they've built, but they haven't been able to sell. That's the unsold inventory. And I'm referring to this chart by Knight Frank, where the blue line, which tells me about the new launches, are exceeding the red line, which is sales. Tell me, Vineet, what actually explains this?
Okay, so the first thing is that the builders have seen the demand from home buyers in the past few years, so they've been excited to launch more projects to meet this demand. In fact, in 2024, new residential launches across top 7 cities reached a record high. Over 3 lakh housing units were launched, and one research report said it was the highest ever supply.
Okay, now I understand that a new project takes a few years to complete. So, my question is, at what stage does a real estate developer's inventory get classified as unsold in India? Right? So, say a developer is launching a new project of 100 flats on 1st January of 2025. And they say they'll complete the project on 31st December 2027. If they get bookings for 20 flats on the day of launch, what does that mean for the inventory standpoint?
So the term unsold inventory used in all these reports typically includes all units, completed or under construction, that have not yet been booked or sold. So in the example you gave, Nitin, people would say the remaining 80 units are part of the total unsold inventory stock from day 1.
That seems a little unfair, and I saw that in 2016, Credai and JLL, they did a joint study to redefine unsold inventory and categorize them into launched projects, under construction projects, which is also termed as to be sold inventory, and unsold inventory, which was for constructed projects. But I guess that actually didn't become the standard and the norm for looking at this.
Yeah, the metric can be a little unclear. But another way to look at what's going on is something called as quarters to sell, or QTS. This looks at the sales velocity or growth of the previous 8 quarters and then calculates how much time it will take to exhaust existing inventory levels if things continued at those same levels. And right now, the QTS metric is at 5.8 quarters, or less than 18 months of stock. And that has been a steady average for a while now. So there are no flashing warning signs right now.
I'm also going to make an assumption here that since this is industry-wide data, it's a mix of popular big builders and smaller unknown developers, and that the grade A developers, especially the listed ones which have a strong brand name and a reputation of a track record, they don't have too many inventory problems. Otherwise, their stock will probably get hammered.
That should be true, Nitin. And if you look at the earnings calls and presentations of listed players such as Shobha, Brigade, and Oberoi, you'll see they are in a good space and they're not slowing down.
So I think from the demand perspective, the peak was 2023. 2024, things started to soften, and 2025, the softening has happened deeper. For listed players, one of the things you have to keep in mind is that while sales are down, project acquisition, the number of projects that developers are taking, that is still very high.
To add on to what Vishal said about demand softening, a JLL report says that for the first time since the pandemic, India witnessed a decline in residential sales by 12%. But a reason why builders continue to launch new projects in this real estate cycle could be deleveraged balance sheets. They don't have as much debt as they used to.
How it is different from the last cycle, I think we need to understand this very clearly, is that when you see the last cycle, maybe the 2011, 2009, those times, a lot of them were leveraged a lot more, which created a lot of issues. Their underwriting on the land, because of the leverage side, also was quite aggressive. This time, however, all of the developers, if you see, the leverage level is very, very adequate.
Now that makes sense, right? Because when the revenues or cash flows are slower, it helps that you don't have an interest payment burden. So lower debt helps a business do better if there is a downturn in the industry. And it seems like real estate companies, at least the listed ones, they become financially healthier than before.
Also, there are a couple of interesting developments in this real estate cycle. You can also get a sense of where the real estate players are concentrating their efforts. They're ditching the affordable housing space and launching projects where demand seems to be more predictable, the segment that can afford houses at a price point of 1 crore or more. Just 5 years ago, over 75% of project launches were in the segments below 80 lakhs. Today, that accounts for barely 35% of new launches.
And if you're an investor in the real estate space, you might actually like that these listed real estate companies are focusing more on the segments that are profitable.
And despite the broad slowdown, Nitin, housing sales for units valued at 1 crore is not seeing a decline. It had a 4% year-on-year growth.
But Vineet, 4% is still a slowdown. It's not rapid growth. So I'd say that we need to probably keep track of that QTS that you mentioned earlier to track inventory. That should give us a clear idea of whether the slowdown is deeper than what we expect. But I have another question here related to the slowdown. Because despite this, house prices seem to continue to go up. I've heard rumors that builders operate in a cartel so that they can all come together and decide not to cut prices even if they can't sell. They'll encourage other builders in the ecosystem too to do the same thing. I know that the experts we spoke to, they said that this is not the case and there's no cartel. So Vineet, tell me what's actually going on.
So continuously growing prices also gives an impression that people are buying, and those on the sidelines also end up buying, thus creating an actual demand and pushing prices higher. But that might not be the only reason. Sometimes the cost of acquiring land and building the project is actually so high that the builders can't really afford to sell below a certain price. In fact, the cost of acquiring land and developing the building keep rising. So housing prices also remain elevated.
So I think you are seeing a phase where there is an intense bidding war, where most non-listed developers can't really make out how the economics stacks up. They can't really compete in this bidding war against listed players, because listed players are looking to a large extent, in the mind of many, not to make profits from the project, but to ensure that their stock remains interesting for the equity players.
Even Manan says he's seeing overbidding, but that's coming from consortium developers and not other listed developers.
There are a bunch of few where there's a consortium which happens. So they jointly bid. So what happens is they are okay where their books are not public. So whether they are making money, not making money, they are not answerable to anyone. Sometimes it's just that they want to do a project here for the portfolio. Now that's what will spoil the market.
In such cases, being a branded, reputed builder helps, and every listed player has their own way of tackling this. For example, MICL does not buy any land it develops. Most of their projects work under a JDA or a joint development agreement. Basically, the landowner gets a share of the business. Instead of selling the landowner gets a share in the profits. And being a listed player in fact helps. Forget overpaying or overbidding. Nirupa feels that being listed helps them get better land deals.
I think with land, a lot of landowners are okay to shave off 1 or 2 percentage points because they would rather go with a trusted player than, say, an unknown player. So just again, throwing out a random example, if we were doing a joint development and, we had to work with a particular landowner, maybe an unbranded player. I'm just saying, suppose he offers 35, 36 or 37%. So say he offers 37%, maybe we could probably get it a little lower than that because they have more faith and trust in us.
Listed or not, some players might be overbidding for acquiring lands, thereby making it the new benchmark for the market. What I mean is that let's say a land parcel should ideally cost 10 crore rupees, but someone overbid and is now paying 12 crores for it. The 12 crore figure will become the new baseline figure in the area, and other landowners will try to sell their lands at that elevated level.
Anyway, we just wanted you to know what might be happening with overall price levels in case you were tracking that to understand whether the sector is slowing down or not. But overall, it looks like the sector has not lost all its steam. The pace may have slowed down, but the sales, they're still growing. For now. So, we've addressed some of the nuances of the real estate industry, and we think we've given you a fair idea of where we are in the cycle. And that brings us to the second question. What are the parameters that you should be looking at to make an investment decision? So tell us that, Vineet.
Sure. So the first thing is the project updates. And within that, you have completed projects, under construction projects, and land banks. Let's look at completed projects first. The number of years of existence of the builder and the number of their completed projects help you get an idea of the developer's track record and execution capabilities. Then you have under construction projects. They give you an idea of the scale of current operations. And then you have land banks. It gives you an idea of how far into the future the developer can continue introducing and developing new projects without having to worry about land prices. However, some players might not have any land banks. Their business model is to get into a joint development agreement with the landowners. For such players, not having land banks is not a negative, but it also limits the visibility of their distant future. Then you have revenue.
But Vineet, within revenues, I've heard that it doesn't quite give us the clear picture of the business and that there are other parameters within this that we have to consider. So tell me about that.
You are right, Nitin. Revenues don't give the complete picture. There are other aspects within revenues. Let me break it down. First, you have sales volumes or bookings. This is the number of housing units sold or million square foot of area sold during a quarter or year. Then there is pre-sales value. This is the value of the number of units sold or million square feet of area sold. Then you have average selling price. This is the price a developer gets per square foot. Comparing the average selling price across developers may not be helpful, but comparing it with the developer's past average selling price will give you an idea if the developer is growing or not. And then you could compare this growth number across developers to identify which cities are growing or which segments like luxury, premium, etc. are growing. And then you have collections. This is the most important number you should look at. And why do I say that? Let's understand with an example. Suppose a builder sold 100 units, each worth 1 crore. Here the sales volume is 100 units and pre-sales value is 100 crores. But has the builder really received the 100 crores? You can know that from collections. Let's say the buyers have only paid about 20% to book those units. So the developer has collections of 20 crores only. That is the actual cash inflow from selling those units. Of course, collections grow as the project nears completion. But if collections remain low, it could be a sign that maybe buyers are unable to honor their dues or the builder has been struggling to complete the project.
So you can see it in collections. So a lot of the developers, they post out these collection numbers. If for a sense, let's say a developer says, I have sold 10,000 crore of sales in this quarter, but my collections is only 500 crores. So then obviously the market penalizes them to some extent because they understand that these sales have come on back of payment, dilution, some, investor speculation.
Then there's something you should know about margins. Two things to infer from a listed player's net margins. If a developer's net margin is say 10-15%, but it sells units at 20-30% premiums compared to smaller peers, their costs are perhaps elevated. Think of it this way. If an average developer sells an apartment for 1 crore, the branded listed players will easily sell a similar apartment for 1.2 to 1.3 crores. That is 20-30% higher than the local rate. Now, if the margin is 12% for a 1.2 crore apartment, the developer incurred all expenses and taxes of worth 1.03 crores. So basically, their costs are more than the selling price of an average builder. Maybe transparency, brand maintenance, and reputation come at a cost. We cannot know that for sure because we cannot compare the financials with those of the unlisted players. The other aspect about margins is that many developers do joint development, and if their share in such projects is less than 50%, they do not report the sales of those apartments in their revenues. It directly hits their profits.
I do partnerships also, right? So when I'm doing partnerships and the equity holding is less than 50%, it automatically doesn't contribute to my top line. The straight bottom line comes.
And that is why you should look at the operating profits. But then the operating profits from joint development projects may not be covered because you only report their profits before tax. So what do? You look at the revenue growth, profit growth, and cash collections, everything to arrive at a decision. But then one more parameter that you should look at is revenue diversification. Many residential real estate companies usually have commercial buildings, malls, or hotels in their portfolios. Some also offer facilities management services, which is basically maintenance of some projects. A facilities management company will take care of a building's security, cleaning, landscaping, pantries, maintenance, and repair work. And the commercial buildings portfolio brings consistent rental revenues for the business. It's the annuity portfolio. When a builder rents out spaces in a mall or a commercial center, the lease rentals provide some stable, consistent cash flows to the business. And leasing is a substantial portion of the revenues of most listed players. Brigade makes 23% of its revenues from leasing, Prestige makes 20%, Godrej makes about 13 to 15%, and Oberoi makes 15 to 16%. So having these diverse streams, even if they contribute a small portion to the overall revenues, helps reduce revenue and cash flow volatility, which is high in residential real estate projects. In fact, analysts are now assigning more value to the annuity portfolio than the revenue contribution.
These annuity portfolios over time has increased. So it used to be 5-6% of the SOTP. They're now moving towards 15 to 20% of the SOTP. And I really believe that when you are standing maybe 3-4 years from today, you would realize that the annuity portfolios are starting to factor like 30-35% of the portfolio.
When Rahul says SOTP, it is the sum of the parts valuation method. In this method, you value each business segment separately. So for a real estate company that has revenues from selling residential units, running hotels, and operating commercial properties, each of these segments will be valued separately as separate business units. And then you add all of those values to arrive at the company value. So you might have a business unit contributing only 10% to the revenues, but your valuation analysis sees more potential in it than the rest of the business. So you might see it contributing more value to the business in the sum of the parts valuation method. And that is exactly what is happening. Non-residential annuity portfolios seem to be contributing more to the value of residential real estate businesses.
Now, Rahul also mentioned geographical diversification in our conversation, and that between 2021 and 2024, the demand cycle was the same across every large city in India. But now the demand across cities is seeing a cycle of its own. And this was actually quite interesting to me because real estate is a regional play. You rarely find many builders playing the pan-India game. You have those that focus on the north, the south, etc. So I wondered if something called FSI or the floor space index matters. FSI in very simple terms tells you how much floor area you can build compared to the land area. If the FSI is 3x, it means you can build 300 square meter on a land of 100 square meters. And since different cities have very different FSIs, I asked Nirupa if builders who operate in cities with a higher FSI can simply build more flats for sales, make more money, and make better margins.
That's not necessarily true. And the reason is because many times when the landowner knows, if a landowner is coming to you, he knows that, okay, you can build this much per acre of land. So he will, so I'm just throwing a number there. Now, suppose if a Bangalore developer might say, okay, give me 35%. A Hyderabad developer, the value of his land is much more because you're able to build more. So he'll ask for a higher share. Then your cost of construction, as you build, go higher and higher increases. And because you can build more, you also have to build more basements, you have to build more car parking, you have to build taller structures, and again, your cost of construction increases. So not necessarily that the margins are higher just because you're going to say a Hyderabad. But that said, if I go to Mumbai, right, because the price point in all these locations are somewhat the same. Like, and if I look at Chennai, Bangalore, Hyderabad, I would say the consumer, there are differences. I'm not going to say no, but by and large, the kind of margins, right, that we look at is somewhat the same. And I don't think that varies because there are always other costs. There's no market that is so good that the margins are so great that you'll make extra. I mean, of course, your sale price will be higher if you go to Bombay, for instance. The selling price of what you can sell in Bangalore could be the profit that you make. Every market is very different, but in Bombay, there are so many other costs. Again, very tall structures, and there are many other costs that you may not be aware of.
All right, so the one question that still remains to be answered, Vineet, is should you buy a house or invest that money in a real estate stock? Because I'm sure you've heard those stories about what would have happened if you'd bought shares in Eicher Motors a couple of decades ago instead of buying a Royal Enfield bike, right? People say that the money would have grown so much that you could have now used all of it and bought a luxury car instead of buying that bike that day. And that's the same sort of question here. But should you really be asking that question? You need a house for your family to live in. Whether you buy one or rent, it depends on what makes you feel comfortable and secure. Everything in life can't be a this or that financial comparison. It really is a personal decision and you shouldn't focus so much on the math behind it. So the question should purely be investment based. If you have the money to invest, should you invest in the residential real estate sector or not? And for that, we will present a bull and bear case for you, and then you can decide whether this sector is worth an investment for you or not.
I will start with the bull case. First, rising disposable incomes. In the last 10 years, India's population has grown from 125 crore to 150 crore. That is a 20% absolute growth. During the same time, India's top 1% earners have grown over 5x. These top earners are the target market for the listed residential real estate players. If their market is growing, so will their business. Number 2, IPO boom. A home purchase is still the largest purchase most Indians do in their lifetimes, and it remains the most coveted purchase. So as more and more startups mature and go for IPOs, a common expectation is that its employees will encash their stocks in or around the IPO and use them to buy homes. So the localities where the employees of those IPOing companies are located will probably see a rise in residential real estate sales. Also, the influx of GCCs and data centers is expected to boost jobs, thereby creating more demand for housing. A report by Zinnov and NASSCOM highlights the rapid growth of GCCs or Global Capability Centers in India. GCCs employ over 1.9 million people and are expected to employ 2.5 million people by 2030. And the role of GCCs is not restricted to a cost efficiency center anymore. Many strategic functions for the parent organizations are now being handled by GCCs. All of this highlights India's growing middle income and an appetite for home buying. Number 3, even if the overall market were to slow down, listed players have the advantage of their strong brands which will have more takers than the larger market.
Definitely, I think there is that advantage because we've been in this business now close to 40 years. It's been 39 years since we started operating. So people have to trust your brand. And again, you asked me earlier why go public. It builds a lot of trust when people have an avenue to see your past history, to understand what you're doing. You have to be very transparent with your finances.
It also helps that they have clean balance sheets and an annuity revenue portfolio. Also, the fact that RERA has made things even more transparent over the past decade by mandating that 70% of the project funds must be kept in an escrow account, meaning those funds cannot be diverted to any other project other than for what it was received, and plenty of other safeguards too to protect home buyers. That's a big positive for the real estate cycle.
Perfect. But now I have a bear case too. And my first point is that India's middle class has gotten bigger. There are more number of people in the middle class bucket and their incomes have also gone up. Just look at the taxpayer data. This means that their buying power has also shot up. But the flip side to that is that now AI has come in and created a sort of an inflection point. There are fears that AI is replacing white-collar jobs in the IT and financial services industries. Both of them are large employers in India. So there's a little bit of a problem with employment and hiring, and this could affect India's real estate in key pockets. Number 2, the Nifty Realty Index that we pointed out right at the very beginning, it's not trading too far away from its 10-year median PE ratio. Also, even if you look at the price to book ratio, that's much higher than the 10-year median. So on both these metrics, depending on what you look at, you could say that the sector is either fairly valued or even overvalued. And number 3, and my final point, is that the segment that is still growing is premium and luxury. Buyers in this segment take a long time to buy. After all, if they're spending crores of rupees, they do want to take a few months to actually think and decide.
When it comes to Tardev, where we're doing one of the tallest towers of the country, there the conversion time is 3 months, 4 months, sometimes 6 months, sometimes 1 year. Whereas in Dahisar, we have a concept called a spot offer. If you come in first time and in the first walk-in, if you book 1 lakh rupees discount. And I have sold more than 100 apartments, you won't believe, in the first visit. Now, these people, for saving that 1 lakh rupees, they transact immediately. But for a richer customer, a high-end customer, it doesn't matter to him. He wants everything the way he wants it. He doesn't want to compromise. He'll go around checking all the areas, vicinities. He'll go with 5 different brokers. He'll negotiate with 4 different salespeople. And, we see these part of the tricks.
And with a visible slowdown, they might take even longer to arrive at a buying decision. That means sales cycles are going to be stretched for the developers. And this does not actually bode well for a sector that you mainly judge based on the cash collections. Anyway, that brings us to the end of yet another T-1 breakdown. Do give us your feedback in the comments below and tell us what other sectors you would like us to cover. And we'll see you soon in the next episode.